Welcome to Investor's Guide. Thank you so much for tuning in. This is part of our 7th year anniversary special. This product and this show has been here for the last 7 years, week after week, figuring out, actually through experience, what is the best way to invest our money and become rich over the long term. Now remember, when we started this show 7 years ago in June 2009, Dhirendra Kumar designed model portfolios for us, designed for different age groups. Last week, we looked at the portfolios that are aggressive and growth portfolios meant for a 25 and a 35-year-old. This week, we're looking at the remaining 3 portfolios. It makes sense to grab a pen and paper because you'll be absolutely marveling at the kind of returns that we're looking at from really simple investment. Let me welcome Dhirendra Kumar. Dhirendra, thank you so much for joining us on the show. It's a massive achievement to be able to do this on a television show and to be able to illustrate this to our audience, that actually stable, steady SIP returns, because we're not just saying it, we've actually done this over 7 years. Stable, steady SIP investments is really the only thing we need to do as investors.
Yes, absolutely. Looking at these returns and doing a recap, doing a review after 7 years, it's very comforting that, these simple principles, having your allocation right, be disciplined with your investments, and not getting distracted by the noise in the market. There are 2 things. One is that right now our performance looks very impressive, but in the worst of times, we were never out of pocket. In fact, on some occasion, most of our portfolio, including this stable growth portfolio, was able to deliver 7-8% return, 9% return, or even 7-8% return, which is better than on a post-tax basis. It is better than available fixed income return, because even if you get 10% fixed income return and you're in the highest tax bracket, effectively it means 7%. If you get 7% here, it is completely tax-free, so it equates. So in the worst of times, these funds or these portfolios were delivering more than what could have been derived by fixed income. So it's extremely satisfying to see the performance and the way an investor has been able to accumulate such sizable amount with such a small amount of regular saving.
And that really is the magic of these portfolios. Just 10,000 rupees invested every month. We haven't started off with a great amount of money, and this goes to all of you who are wondering that, okay, maybe I'll accumulate some money, then I'll start investing. You don't need to. Start with the smallest amount of money that you have on a monthly basis. 10,000 rupees invested every month for the last 7 years, and this is what it has amounted to. The portfolio fundamentals remain the same, and these are rules like that Dhirendra has been talking about, that we've been talking about every week for 7 years, which is we've only used SIPs. We haven't made any lump sum investments. We haven't made any big, massive changes. We've not stopped our SIPs at any point. We haven't panicked. And of course, we've kept it very, very simple. Our next portfolio, which is our stable growth portfolio, is really an illustration of keeping it simple. Just 4 funds, that's all this portfolio has. It was designed for a 45-year-old. Take a look at the returns. All right, so that's our stable growth portfolio. A quick recap of those funds: the Canara Robeco Balanced, HDFC Prudence, ICICI Prudential Balanced Advantage, and the Reliance Regular Savings Balanced Fund. 10,000 rupees again invested every month in this portfolio. It's currently valued at 13.78 lakh rupees, with a total gain of 13.84%. Dhirendra, and this has always been my favorite among all of the portfolios. A, because it's so simple to understand. It's so simple to follow. Also, because despite the fact that it's a stable portfolio, it has always done marginally better than our growth portfolio. Are you really proud of how this portfolio has played out?
Yeah, I'm proud and little embarrassed about the performance on a relative basis, embarrassed about the growth portfolio, which in normal scheme of things should have delivered more. And but that apart, this is shockingly simple. This is something which we often recommend to our investors. Somebody getting started, he should get started with this. somebody, because most investors in India haven't experienced equity, and whenever they do, it is normally at a time which is very inopportune. So it is very important to have an allocation, and so the principle was very straightforward: 65 to 70% into equity, 20-30% into debt. It has worked out very well for us because 4 funds ensures that it was primarily driven by the need for an investor to have his anxiety in check, need to keep it simple because you don't have to rebalance. If you rebalance on a 30% allocation to fixed income and 70% to equity, you will have to do it at least once a quarter. Here it is happening automatically at the fund by the fund manager is taking actions to ensure that. The tax treatment remains that of an equity because that is what our tax laws say, that if a fund is invested over 65% into equity, it will be treated as equity. So all these things combined together, and then looking at these performance, I think we are getting brilliant skills at work here.
If we look at the specific funds, of course, and this is a really simple portfolio. To just recap to our viewers why this portfolio works so well, is because when you're 45 years old, which is the kind of person this is designed for, and you don't want too much volatility in your portfolio, you're only looking at 4 funds, which means that the amount of time and energy you put into tracking them, maintaining them comes down drastically. There are only 4 funds to look at. Because they're balanced funds, they still give you a debt exposure, but they're completely tax-free if held after 1 year. So that's a massive advantage as well. The third advantage is that they rebalance themselves. So like Dhirendra says, if the market goes down a lot or up a lot, the funds automatically rebalance themselves. It saves you one more step in the management of your portfolio. Dhirendra, this portfolio has the HDFC Prudence Fund. It's currently 2 stars on Value Research. Would you recommend, I mean, when we invested in it, I remember it was one of the strongest performers in its category. It's no longer the strongest performer. But just generally as being part of this portfolio, does it still hold water as a choice that you want to hold on to? Or is this something that you're going to relook at over the next couple of weeks?
We might relook at it, but looks unlikely that we will actually drop this fund. Because this is one fund which, if you look at, despite the recent underperformance or substantial underperformance, this fund is getting, our market is getting into a phase where this fund is beginning to get into favor again. That apart, look at the annualized return of the individual funds in this portfolio. HDFC Prudence, despite its, substantial underperformance in last 1.5-2 years, it still is comparable. It's hardly 5 basis point difference between the best fund and the not so, and the very disappointing Prudence fund. So I would say that things move in a cycle, and if they are governed by a certain way of management, then there is a possibility that some of the best performing fund of recent times will struggle at some point. So that is the rationale for having this portfolio of 4 funds. That something doesn't do well, we should try and look at the reason. If the reason itself is questionable, if the fund did something wild and crazy, which we had not bargained for or was not part of our framework in its primary selection, then it would have been dropped in this portfolio already. But not for that reason. Plain underperformance is not the reason to drop a fund. And I think Prudence is gaining traction again.
Prudence is gaining traction again. That's a very interesting statement. We're going to keep a very close track on that fund. And I'm going to give you a recap of the 4 funds in this portfolio. This is our stable growth portfolio. We have the Canara Robeco Balanced Fund, the HDFC Prudence Fund, ICICI Prudential Balanced, and of course the Reliance Regular Savings Balanced Funds. A recap: 10,000 rupees invested every month over the last 7 years. It's currently valued at 13.78 lakh rupees with a total gain of 13.84%. This is by far my favorite portfolio of the 5 that we have, but we'll take a quick break. We'll come back on the other side and we'll talk about 2 more portfolios designed for people approaching retirement and those already retired. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. This is our 7th year anniversary special. We are, as Investors Guide, India's longest running personal finance show. And that's beautiful for several reasons. But the thing that means the most to me is the fact that we've been able to illustrate from example in the last 7 years what it means to invest your money through SIPs in a calm manner without reacting to any of the ups and downs to the market. We've actually managed to show returns. The architect of those portfolios, Dhirendra Kumar, joins us on the show as well. Dhirendra, let's take a look at our conservative portfolio. This was designed for a 55-year-old, so someone who's about 5 years away from retirement, where your main need right now is to beat inflation and, of course, to protect your capital. This is our conservative portfolio. Take a look. The portfolio is done very well. The FT India Dynamic P Ratio Fund, the HDFC MIP and the Reliance MIP. We've been investing 10,000 rupees every month in this portfolio. It's given us a gain of 10.12%, Dhirendra. Are you happy with the portfolio? Is this how you hope that it would play out? Because 10% is a great return in the market we've had over the last couple of years.
No, personally for me it is not a very inspiring return. It's not a very, I'm not very happy with this. I think there are 2-3 reasons. One, that why it is disappointing is that look at last 7 years where inflation has been very high. So you have got very little return over inflation. That apart, most of the return derived in this portfolio is not tax-free. It is not derived by way of equity fund. This fund has about 20 to 30% allocation to equity, and that makes it not very tax efficient. So the return will be taxable post indexation because it has been accumulated and built over a period of time. But it is not greatly disappointing, and it's not very encouraging. I would just put it that way. And one more reason why the returns are very relatively low is that some of these, this portfolio is built with the dynamic P ratio fund for the dynamism of ensuring that it is properly allocated to the two asset class, and 2 MIPs with relatively aggressive allocation to equity, 15 to 25% allocation to equity. For that reason, we chose these two MIPs. I think moving this portfolio to the direct plans will enhance the return by about 1% more, which will be quite meaningful. That apart, I think we need to think little harder about how to make it little more tax efficient. Can one of the component be in equity in a manner that the return can be enhanced by the tax treatment? And today we have available vehicles, so this particular aspect will also be addressed, because today we have some of the conservative balance fund available in a structure where the fixed income is derived by way of arbitrage position, where the tax treatment is that of an equity, despite having a very conservative allocation to equity.
Dhirendra, I also want to ask you about the MIPs in this particular portfolio, the HDFC MIP long term and the Reliance MIP. We have had conversations on this show about the fact that MIPs again are not the most efficient way to approach investments, because they tend to be inefficient in their manner of functioning. The HDFC MIP long term is also a 2-star fund. Will this portfolio again need maybe a relook at least from the MIP point of view?
No, I think from MIP point of view, these are, despite being their lower ratings, these 2 funds are the finest choice among MIPs, purely based on return. And the way why these 2 funds have lower rating is not because they are bad MIPs, just because they have higher allocation to equity, so they tend to be more volatile compared to other MIPs, and in this category there are MIPs which do not exceed 10% to equity. So these are by the formula of estimating the riskiness of a fund, these funds are getting a lower rating. But my benchmark of an MIP is that, is it really beating the post office MIP? That is the real expectation of an investor who is investing in such a fund. And these are the only two funds which have done it most consistently. In the worst of times, most other funds really struggled. In fact, they struggled so much that we realized that even a 5-year return on many of the MIPs was proving to be half of that of the fixed income. So they were not great value for the risk that they were assuming. At least these two funds are compensating for the risk that they assume. Not enough, and I think they're very expensive. That's the bad part of these two funds as well. And so in that sense, they are not the finest choice, but we don't have alternatives.
This is our conservative portfolio, the FT India Dynamic PE Ratio Fund of Funds, the HDFC MIP Long Term, and the Reliance MIP. We've been investing 10,000 rupees a month in this portfolio. It's currently at a total value of over 12 lakh rupees. This is meant for someone who's approaching retirement, whose main concern at this point is to keep the volatility in their portfolio as low as possible. Moving on to our income growth portfolio, this is our last portfolio, and the two of them are very similar, which is why I want to address them together. Our income growth portfolio is designed for someone who's already retired. So this is not an SIP format portfolio. This is someone who's put in a lump sum and will possibly withdraw from this lump sum a regular income on a quarterly basis. These are the funds in the portfolio: the FT India Dynamic P Ratio, the HDFC MIP Long Term, and the Reliance MIP. We just talked about how they're the best options in terms of MIPs to choose from, and also the UTI Balanced Fund, which puts in a small kicker of equity into this portfolio. Now, this portfolio is currently at a total value of 12.16 lakh rupees. This has always been a very interesting portfolio because it functions differently from the rest of our portfolios, and because we get so many questions from people who are already retired, who have a lump sum amount that's come in from their retirement corpus, and they want to know how to invest that in the stock market, because the other options tend to be very debt-oriented. So tell us if this has worked out, if you're happy with the returns that you're seeing, and if this is a portfolio that you will freely at this point recommend to anybody who's retired.
Yes, absolutely. But I would like to clarify that what one should expect from this portfolio, and it is a very crucial piece of advice which has become all the more relevant now. Your return on guaranteed pension, guaranteed income product is coming down. So every investor in retirement who has, who does not have access to regular income by way of work, compensation, needs to really worry about. And initially, 7 years ago, we thought of this portfolio as a supplementary income portfolio. You are deriving your regular income from elsewhere. Either you have a rental income or you are getting your pension, and periodically from your investment you want to have some periodic income. So what we did was, this was a 10 lakh rupees lump sum investment, and we planned a 8% annual return derived quarterly from that 10 lakh rupee, which means that every quarter an investor was withdrawing 20,000 rupees worth of was deriving 20,000 rupees from this portfolio by redeeming his units proportionately. And despite that 80,000 rupees annual withdrawal, which is a 8% return, your capital is up, your principal is still up 20%, and one has derived 80,000 rupees every year, 20,000 rupees every quarter. So this portfolio has done reasonably well, and more investor needs to look at it, because compare this with something like a post office or a bank deposit, and if you are in the quarterly interest payment format or a monthly post office MIP, then your capital would have remained constant. If you would have invested 10 lakh rupee, that 10 lakh rupee would have remained 10 lakh. So that is the key lesson or takeaway from this portfolio, that even a small allocation to equity, it is able to boost your capital. Your capital has gone up by from 10 lakh to 12 lakh rupees while you have derived 8% annual income. And things might change. I think we need to really work on enhancing the return in this portfolio methodically, with some other basic selection enhancement that can be done. There could be occasion in the life of this. There has been, at least 2 occasions when if you would have rebalanced little more, actively, it would have enhanced the return by about 3% more.
Well, Dhirendra, I also want to very quickly ask you about the UTI Balanced Fund. It's 2 stars on value research. And I remember when we picked this fund for this portfolio, the idea behind the fund was for it to give in, even though it's a very conservative balanced fund, to offer that little kicker of returns that will come in from equity. Are you happy with the returns you received on this fund?
I'm fairly happy with the return from this fund. And, the return that we see here is also hostage to the point at which we bought this fund. We did not have the choice of, the point at which we created this portfolio is the time when we actually, we are locked into our return. Our returns are visible today as a function of when we bought this fund. Maybe if it would have been staggered a bit, the ideal way for most investors to build such a portfolio is that if you have to invest 10 lakh rupees or if you have to invest 50 lakh rupees in a portfolio from which you will derive income, it should not be done on one day as this portfolio was done or the way it was crafted. So things could change, but I would say that today we have far superior vehicles. They are also more tax efficient, and UTI Balanced Fund has definitely lost a bit of its charm as it had when we started.
All right, UTI Balanced has lost some of its charm. We're going to keep a close eye on this portfolio. I'll recap the income growth portfolio for you. The FT India Dynamic P Ratio Fund, the HDFC MIP Long Term, Reliance MIP and the UTI Balanced Fund. We've come to the end of this show, but Dhirendra, I think, and I want to thank you for the continued attention to these portfolios and the continued attention to our investments over the last 7 years. I know there are viewers who feel the same way about it, and our email ID is on the screen for anybody who has a question for Dhirendra Kumar. Dhirendra, we appreciate your time, but I want you to also give our viewers a word of advice on taking these portfolios, using them as their own, or taking any of the advice they hear on the show and using them as their own. What advice would you give anyone right now, putting aside a small amount of money every month in order to become rich over the long term?
2 things which comes to my mind, and of course one thing very personal, that I have never carried something so long, so consistently. So it is very satisfying and gratifying carrying these portfolios and looking at it and resisting the temptation to not to unnecessarily fiddle with it. In fact, many a times there were solid reasons which I have resisted for the sake of core principles that is it really needed. But 2 things which comes to my mind. One is get started, and after you start, don't get distracted. If you do these 2 things, we have the evidence. You can convert this into something sizable.
All right, I want to give you a recap of our basic rules on this show. Always use an SIP. Always use an SIP. Keep it simple so it's easy to manage and it's easy for you to stay consistent. And of course, don't panic at any point of time. Just continue with your long-term plan. Do not get distracted. Do not panic. Do not stop your SIPs. Dhirendra, thank you so much for joining us on the show, and thank you so much for the last 7 years of your time and energy. I want to thank our viewers for your continued support. We will, of course, on this show, stay with you, hopefully for the next 7 years. Over the next couple of weeks, the entire show is going to receive a complete makeover, and we're going to come to you with a brand new show that will look completely different, but our principles and our philosophy will stay the same. Thank you so much for watching Investors Guide.